Good evening, everybody. My name is Paul Johnson. I am the chair of the Emerging Company and Venture Capital Group at the law firm of Procopio. So I'm a partner here. I'm also co-chair of our M&A practice and help run our corporate team. So lots of hats. And that means I've been doing the law for a long time and looking forward to talking about the principal things that you want to think about when you are forming a new entity. One of the things that you need to decide early on is what type of entity you are going to choose. And another one of those questions is where you want to form that entity. Speaking to someone today who has a Georgia corporation, that is not a typical corporation, and we'll get into why that is and where you should choose. And then deciding who's in and what they're responsible for. That's a matter of forming your team and allocating not only responsibilities, but allocating ownership. And there's a few things you may want to know about the process. Choice of entity. If you're here on this presentation, my guess is that you are thinking about forming an entity because you want to raise financing for your new startup. And kind of the TLDR version of this presentation is, if you want VC investment, you probably want to lean heavily towards a C corporation, and we'll get into the reasons for that. You do want to call a lawyer to go through your personal situation and expectations and make sure that anything I tell you is applicable to you. It may or may not be, and that's why you have your own attorneys that help you out. So you're aware this is general advice, and nothing is a substitute for kind of getting the specifics that are right for you. And there are reasons why you would use other entities or other states than what I'm going to tell you later. So your choices of type of entity, basic forms of business entity as follows. But maybe we start from the top. Why do you need an entity? Why don't you just do your business on your own? You can. There's something called a sole proprietorship. You can do the business. You can go out and sell stuff, sign contracts in your personal name. You probably have heard lawyers tell you that's not a great idea. Why? Because any liability of your business is your personal liability. And so that's not great. You know, someone slips and falls on your property, you get sued. If it's your house on the line, your assets on the line, you could lose those assets. Whereas if you run the business through an entity, you have some protection against that sort of situation. So that's why you think about an entity. Not all entities are created equal, and that's why we're here talking about it. The first basic type of entity is corporation, advantage, limited liability. You're going to be protected from a lot of those situations, not all. Talking to a lawyer here, everything is subject to caveats. Disadvantage of a corporation, at least for C corporations, there are two levels of tax. There's an exception for S corporations, and I will get into that in a bit. And that's why a lot of people think about using an S corporation, but there's more to that, obviously, as well. Partnerships. The advantage there is generally there's one level of tax at the owner level, but the disadvantage is even in this form of entity, partners are jointly and severally liable for debts of the business. And it's not just debts of the business, it's debts that your partner enters into on behalf of the business. I have a friend who is a medical practitioner who was in business with a partner, and that partner went out and ran up a whole lot of bills without consent from my friend. And yes, my friend was in fact jointly and severally liable for those things because the partner was acting in the name of the business. And he could have done the same thing to the other partner. It took them years to extricate themselves from that situation. Partnerships are not typically the right answer for operating businesses. Anybody would come to me and says, Paul, I want to form a partnership. I'd talk to them at length about the risks of that, and probably not the right answer if you can at all avoid it. Sometimes you can't, but most of the time you can't. So last on this list, limited liability companies. What's the advantage? Well, like a corporation, it's limited liability. Thus, it's in the name. Also, like a partnership, it's one level of tax. So wait, you got the best of both worlds here. Disadvantage, if there is one, it's that corporate governance is by contract. We'll talk about that more in a minute, but everything is negotiated in an LLC as opposed to in a corporation where a lot of it is subject to state law. So we'll get into that in a minute. Exceptions, you heard me talk about before. An S corporation can, in fact, avoid that second level of tax. When I say two levels of tax, just reminder, I mean that the entity is taxed as the first level, talking about a C corporation principally. So it's going to pay its tax rate. I can't remember off the top of my head what it is, 20-something%. And then when the corporation, after it makes a ton of money, which is what we all hope happens, it distributes that money to its shareholders. Well, if you're a shareholder of a C corporation, you're going to be subject to another level of tax on that dividend. It can be up to 20-ish% as well. There are some other more advantaged rates that can apply in certain circumstances. However, C Corp, you're looking at a lot of tax by the time you add it all up. S corporations, you avoid that second level. What's the second level? There's no tax at the entity level. You're just taxed at the individual level. So that's great, right? Now, what's that individual level? It can be up to, I think, 37% is the top marginal personal rate. If you're making less than that, it's going to be less, but that's your tax, is whatever your personal tax bracket is. So in an S corporation, you make $1 bazillion. That $1 bazillion shows up in your income as an owner, just as it would be if you were operating a sole proprietorship, right? So that sounds good if you want to make a lot of money in the entity and it's going to be spinning off cash and you have cash to pay yourself to pay those taxes. And I'll talk about that more in a minute. There's a difference between making money and when the obligation to pay taxes on it occurs in S corps and C corps. This is one of the main disadvantages of an S corp. There are very strict rules. Just a bit of a preview. You can't have a second class of stock, which is why I said at the top, if you're talking about doing a venture capital fundraise, you want to raise money from an institutional investor. They typically want to own preferred stock. And then that's also typically an entity that's investing. And if you're raising money from angels, that doesn't apply. But you've looked at the third bullet here, no entity owners. There are some exceptions to that, not many. So generally, you can have an S corp and you can have one level of tax, but you've got to meet all these criteria, and there are many more in addition to what's here. I'll get into a few more on a future slide. So another one is limited liability partnerships. I'm not going to talk a lot about those because those are really kind of special circumstances that we use those. They're typically related to general businesses. So we're just going to skip over those for the time being. We deal probably 2/3 of the time in corporations. Probably less than half of those are S corporations and the other is LLCs. So differences, C corps. As I mentioned before, one of the advantages, if you want to call it that, is that the corporate governance is dictated by statute. If you want to look up Delaware General Corporation Law or California Corporations Code, you will see online, they're available online, the rules that govern the governance of corporations. Latter being in California, former being Delaware, and the laws are different, but a typical corporate lawyer knows their home state, and for me, that's California and Delaware, because Delaware is so popular. We'll talk about that in a moment as well. So what does that mean? You can't contract around some things. For example, I've been in attendance at board meetings before for a corporation, C corporation, and someone says, oh, Bob or Susan can't attend. They're sending someone by proxy, or they've given someone else their proxy. You can't do that in a corporation. The board member has to vote. It's not something that they can give a proxy for. You can give a proxy for ownership of stock and voting of stock, but you can't at the board level. Dictated by statute, can't contract around that. In an LLC, yep, you can. There are very few restrictions on who can own stock in a C corporation, so pretty free, and you pay for that with the second level of tax. You can have different classes of stock. So again, if you plan on raising money from a professional investor, venture capital fund, institutional investor, you can have the preferred stock that they'll want, and you can sell to them even though they're an entity. The dividends do have to be proportionate by class. You think about it, if there are 100 shares of common stock and you distribute $100, everybody's going to get $1 per share. You can't say, oh, Bob is a better person than Susan, and therefore he gets more per share than she does. That doesn't fly. So that's got to be proportionate. And again, it's the most common entity for VC investment and ultimately public companies. And one of the reasons is it's easily understood. Partnerships, including LLCs for that purpose, are a little bit harder to get your arms around. The taxation can be complicated. This is easier because there's no second level of tax. There is a second level of tax. The corporation, when it makes money in a C corp, it pays its own taxes. If it doesn't distribute out dividends, the owners don't have to pay taxes unless they're selling their stock. The earnings and the losses of that corporation are within the corporation itself. It is, for purposes of the law, its own person, which has profits and losses, and they don't pass through to you, unlike an S corp. Another big reason for choosing a C corp is something called 1202 stock, qualified small business stock. If you don't know what that is, you may want to Google it. Look it up. The bottom line is it's a highly tax-advantaged way to own an entity if you meet the criteria. And there are criteria about the size of the entity. There are criteria about it has to be a C corporation from the start. So as I understand, there can be exceptions to that. But the general rule, and then you can't have done redemptions of stock in the past. You can blow your qualified small business stock exemption for that. But if you qualify, it can be a really big deal, as in eliminating all or most of your taxes on sale. So that's only going to work for a C corp. So that's a great way to start. Again, particularly if you're going to be raising institutional financing, you think that's on your path. This tax advantage is lined up for you to use. It is actually very hard. Should you just be thinking about, well, maybe I'll start with one and move to the other? It's actually hard to start with a C corp and then move to an LLC. For tax purposes, that's deemed to be a distribution of the assets, which is taxable, and a recontribution into another entity. So that change can trigger all kinds of taxes. You can do it if the corporation is not worth a lot. You're still going to take the taxes. It's just tax on not a lot. You can, however, move to an S Corp from a C corporation. You simply make an election with the IRS, presuming you meet the rules. The issue there is the IRS will get its money. There's something called a built-in gains tax, which if you make this move, you need to get a valuation. And then whatever the value of the company was at the time you made the election, you're going to be taxed as if you were a C Corp on that portion of the value of the corporation if you do a sale within a certain period of time. And that period of time, as I understand, varies from jurisdiction to jurisdiction, as in from federal to state. But you can do it. And I have a client that's involved in a sale process right now that did do it. A little over $1 million in tax it has to pay because of this choice. But overall, I think they're glad they did it because of the other advantages of S Corps. Main disadvantage, again, separate tax status, talked about that a minute ago. It pays taxes on its own profits and losses don't pass through. In other words, if you got a C corporation that's running $5 million of losses and you're the sole owner, guess what? You don't get to take those losses on your taxes, which you do in other entities. That's C Corps in a nutshell. And again, institutional investment in your path is probably the way you want to go. Now, if that's not on your path, here are the alternatives. S Corps. Can a venture capitalist invest in S Corp? They theoretically could, but it would immediately become a C Corp. So you want to see that coming. You don't want that to happen to you accidentally, because if that happens to you accidentally, and that's kind of the way S Corps are, if you violate any of the rules, even if it's not on purpose, you may find out later, your accountant may tell you, or the IRS may tell you, guess what? You lost your S corporation status on January 5th of 2025, and everything that happened since then incurred 2 levels of tax. That is one of the disadvantages of an S Corp. You can kind of trip and fall and become a C Corp without knowing it. 1 level of tax, and profits and losses pass through to shareholders. That's both good and bad. So in my other example, you making $1 million a year in your S Corp, that profit passes through to you. It's going to show up on your own taxes. You have to pay tax on that, and that's regardless of whether the corporation pays you any of that cash. And this client is talking about that's in the process of a sale right now. They didn't have enough cash to make that distribution last year. And so those shareholders are in the position of wanting to get paid to pay their 2024 taxes. And luckily, it's going to happen, but they had to wait, and it was a little nerve-wracking. Again, there's a disconnect between when the taxes show up and when the company sends you money. If you are running the company and you can determine, oh, I'm going to make myself a distribution so I can pay my taxes, presuming the cash is there, that works. If you're a minority investor in an S corporation, you're waiting for someone else to pull the trigger. So again, that's bad theoretically from the profit standpoint. Profits, you think, oh, profits are great. I love profits. I want lots and lots of profits. Yes, absolutely. But IRS is going to want their taxes. Now, what happens if you have $1 million to $5 million in losses? Bad. Yep, absolutely. Bad thing. You don't want to be losing money. However, those losses pass through and show up on your taxes, on your tax return. So depending on the nature of the losses, you may be able to offset some income that you're making somewhere else. And that's a good thing. If you're going to have losses, you'd like to use those losses to eliminate gains somewhere else and pay less in taxes. That is a possibility in an S Corp, which is why a lot of startups come to me asking, should I be an S Corp? And the answer is usually, well, you're going to raise institutional money, going back to the main theme, then probably not, but we can talk it through. There's also a separate California state tax, of 1.5% of net income. So notwithstanding, I said there's no tax on the at the entity level. Well, guess what? California, they're imposing one, and there are always exceptions, right? Here are a little bit more full list of some of those restrictions I talked about before. You can't have more than 100 shareholders, so that usually most people don't think they'll get there. I have one client that's getting really close. It was an S Corp, and it chose to go to C Corporation anyway. Owners cannot include corporations, non-resident aliens. So if you have someone who is living overseas and they are a citizen of a different country than the United States, they don't have a green card, then they cannot be an owner of an S Corporation. Partnerships typically also can't be an owner. There are exceptions, and most trusts also can't be shareholders, again, subject to some exceptions. But by and large, if you have an entity that needs to be a shareholder of your S corporation, probably going to blow the rule. Again, only one class of stock, so all S corps have common stock. You can have different voting rights and have a Class A and Class B if the only difference is voting, but you can't have Class A and Class B if there are economic differences. And you have to make an IRS election. It doesn't just happen. You make the election, you have to qualify, and then again, if you fail to qualify at some point, you can become a C corp inadvertently. Tax impact is unfortunately less predictable to investors as a result of this profits and losses passing through. Let's imagine for a moment you're a bazillionaire and you have $500 million in an S Corp, and they report to you, we had a fantastic year. Guess what? you have to pay a bunch of taxes and we're going to hold the money for you. We're going to hold the money. We're not going to make distributions. Well, now you got to come out of pocket. If you're a bazillionaire, you don't care. If you're not a bazillionaire, you have an investment in an S Corp. Maybe you want the cash to pay your taxes, and you have to have some form of understanding or agreement with the company to make sure that happens so you can pay those taxes. If you don't get the cash, let's imagine you are, say, a pension fund, and you would ordinarily not be subject to tax. You can have taxes inadvertently here, and that's kind of one of the problems with VCs. They don't want their investors, many of whom are pension funds, having income pass through up from the portfolio company into the venture capital fund, which is typically also a pass-through entity, not an S Corp, but a different form of one, and that it passes up into those investors. And that can trigger taxes that they are not prepared for. And so that's one reason why, the principal reason why VCs don't invest in S Corps, unpredictable tax outcome for themselves and their investors. And that's a very, very high level view of that, a high level summary, probably inaccurate in some instances, some at the margins, but that's the general rule. VCs generally prefer not to invest because of that tax issue. S corporations also share a complication with using equity comp. Now, you can have an option plan in an S Corp if you want to give options to your employees, but they can get very complicated. What happens, for example, if you have an option holder, you want to give an option to someone who is not a green card holder or U.S. resident. Well, once they exercise, now you've violated the S Corp rules. That's just one of the complications, one of many complications, and sometimes very material complications of having equity comp in an S Corp. So last kind of form of entity, just so everyone kind of has it on their radar, LLCs, limited liability companies. Key advantages, they are pass-through like an S Corp, but they don't have those pesky S corporation rules. So you can have multiple classes of stock. Good. You can have equity owners that are entities. You can have multiple classes of stock. Good. So you're asking me, why don't VCs invest in LLCs? It's back to that pass-through tax issue and having unpredictable taxes for VCs and their owners. So they don't like to invest in LLCs either. Now, if you're the hottest thing ever, you're the next, name your successful public company, they may find a way to invest in you. One way that they invest is to form a C corporation that they invest in first, and then that C corporation invests in you. It's called a blocker. So now they've technically invested in a C corp. You don't have the tax issues. And if they really, really, really love you, they may be willing to do that. But that kind of adds a new list of things that you have to convince them of. And not only is your business worthy of taking investment because you have this hot new technology, molecule, et cetera, but, oh, guess what? We're an LLC and we're not going to change for you. Then they have to get over that as well. And typically, the fewer things a VC has to think about, the fewer things they have to get over before writing you a check, the better. So LLCs, again, not the preferred vehicle for taking venture investment. However, it is the preferred vehicle for stuff when it's not on your path. So if you're saying, Paul, you keep talking about VC investment, that's not where I'm at. This very well may be the answer for you, an LLC. They are governed by contract, which is a plus and a minus. You get to negotiate with your co-owners everything. I referred you before to the Delaware General Corporation Law and the California Corporations Code. Those don't apply. Well, there are a different version of those for LLCs, but by and large, they allow you as much flexibility as you can get, subject to some baseline rules. As always, there's an exception, but by and large, you can negotiate a contract with people and change things around. You want to have proxies at the board meeting? Sure. You want to pay someone else before you pay another person? You want to make disproportionate distributions? Yeah, you can provide for that in your LLC agreement. If it's by contract and everybody agrees, you're good. So lots and lots of flexibility. So there you go. One of the principal advantages. Disadvantages, there you go, not governed by statute. So you got to negotiate all the rules up front. Fortunately, when folks come to lawyers and say, I want to do an LLC, because we have to set up everything in advance, you're not relying on a bunch of statutes that were passed 100 years ago. Everything's open for negotiation. And that means that negotiating and drafting the documents can be more time consuming and therefore more costly from a legal fees perspective. They're also subject to a special California tax on gross receipts. So there is some entity level tax in California. Equity compensation is even more complicated in an LLC than it is in an S corporation. Options are like so hard. I don't think I've ever seen an LLC option agreement. I think you could theoretically write it, but I think from a tax perspective, I'm told by my tax folks that they don't really know what it would mean, how that would be treated. And you certainly can't issue something called ISOs, which are tax-favored versions of stock options, incentive stock options. Those work in C Corps. And the basic is, if you're going to give equity comp to employees, ISOs are great because they allow your employee to exercise the option assuming it's vested, but they can exercise and there's not a tax if there's a difference between the value of what they're paying and what they're getting, meaning you gave that to them a couple of years ago, they're exercising now, company has quintupled in value since the time of the option grant, all that gain not taxed yet for an incentive stock option. And that's very attractive for employees, available only to C Corps. Now you can do equity comp in LLCs, but like I said before, since this is kind of a creature of contract, so is the equity comp, which means that it's very bespoke. And when you think that, you think, doggone it, I have to call that annoying Paul guy and have him work on something for me at his incredibly high rate. I'll say my rate is not incredibly high, but it's up there. All lawyers are expensive and you're going to pay them by the hour to deal with equity comp issues in an LLC. There you go. Certain licensed professionals cannot use this form in California, like an attorney. That's why we go to limited liability partnerships. The name of our firm, Procopio, Corey, Hargreaves, and Savage, LLP. That's why we're an LLP, because we can't be an LLC. So that's another thing, but only for licensed professionals. Do you really need to worry about that? But again, bottom line, here's your bullet. Rare for VCs to invest in LLCs for tax reasons. However, if you want to start as an LLC, you say, Paul, boy, that sounds great. I do want to take losses in the beginning because I'm going to be running at a loss. I'm going to be funding this out of my pocket. I want to use those losses to offset other income. You can, in fact, relatively easy start with an LLC and then change to a corporation. There's pretty simple filings that are made in each state. The one complication, I guess two complications I've got here is if you have issued multiple classes of stock, it may be a little bit of an exercise to give everybody the same economic position in the new corporation as they had in the LLC. That's something you'd have to think about. And then if you granted a bunch of equity comp in the LLC, again, because those are typically bespoke agreements that take legal time to put together, converting those into an option plan may require you to have a conversation with each owner of the equity comp, which is never good. Let's say you've got 15 employees and that's relatively small, right? You really want to have a 15-way negotiation to figure out if you've got all the permissions you need to switch from C Corp to LLC. That's hard. You get one holdout, the rule of averages applies. If people are on a bell curve, and they kind of are, you're going to have one person at one far end of the spectrum that's totally easy, will sign anything you put in front of them, and you'll have someone else that's on the far end of the spectrum saying, there's no way I'm signing it until I have my lawyer bless it, and I want you to pay my legal bills. I've seen that happen. So there you go. Easy to start, but to make it easy to change, you may have to kind of live life in a certain way that makes it easier for you. So there you go. Other tax issues, just kind of throwing it out. We've covered some of this before. C Corps, no self-employment tax. Since there's no pass-through of profits and losses to owners, they're stuck in the corporation. You may have heard this term, NOLs. That's a term that applies to C corporations. If they have losses, they take a $15 million investment from a venture fund, they spend it all, and they haven't sold a product yet. They probably have built up assets with that $15 million, but they have losses technically because they've spent it and they haven't made any profit. Meaning they probably paid employees, they paid, let's say drug developers, or they paid software engineers, all that $15 million created losses. Those losses are locked in the corporation. They actually become a corporate asset, meaning once the corporation starts making money, it will take those NOLs and will apply it against that money. So it doesn't have to pay taxes for a while. Again, it's its own person under the law with its own balance sheet, as you know, its own finances, its own tax situation. So that's what happens to losses in the C Corp, but you can't take them out and use them personally. As a matter of fact, you can, in fact, lose them if you have certain transactions. S Corps, other tax issues. Generally no self-employment tax, good thing. Again, as I talked about before, the income and losses flow to owners regardless of whether there's a cash distribution. And again, there's a bifurcation between being given the taxes, being allocated taxes for purposes of the IRS, versus being given the cash that you need to pay those taxes. And corporations that are in startup mode, growth mode, many times they need the cash to do other things and they don't distribute it out. So if that's the plan, you need to plan for, what's going to happen if we're profitable. We're going to keep all that cash in the business. If you are, you're going to have to come up with the money to pay the taxes. LLCs, add the self-employment tax on there. Another thing that people don't often think about immediately when they're thinking about forming an LLC is the owners usually think, we got 3 founders. We're all going to be employees. Well, that's not the case for an LLC. If you form as an LLC, the owners can't be employees. They're not technically employees. When I'm saying employees, what's an employee? Employee is someone that works for the organization and gets paid, and they get a W-2 at the end of the year for their wages or their earnings. That's not the way it works in an LLC. If you pay the owner of an LLC money, that's not a wage. That's a distribution. And again, it's bifurcated from the tax. That's just a distribution. independent of whether the entity has made or lost money. So you have the same issue with an LLC. You probably want to make distributions to pay taxes. But if you start getting of a certain size and you say, hey, I want to bring in some of the other people besides the first few people that are the best buds and get along great. Now you want to expand to 10 and you want to give those people, again, equity comp. You want to make them co-owners. What do? Well, one of the difficulties in an LLC is you make them an owner, they're not an employee anymore. They're not going to be subject to withholding, which may sound great for you, but lots of people have gotten themselves into trouble when their wages weren't having withholding done. And people need to understand that. It's not for everybody. Some people would have a hard time kind of getting their head around the idea that I'm responsible for paying my own taxes. The company didn't remit them to the IRS for me. What happened to my W-4? You don't have a W-4 in an LLC because there's no exemptions to claim against your earnings. You are an owner and you are taxed like an owner. You get a K-1 instead of a W-2. Just a little bit of a complication happens. It actually comes up quite a bit as we're talking about the nuances of really operating an LLC. What happens to the 15 people we want to add and give equity to? Well, they're your partners too, just like a partner would be in another entity, just minus the joint and several liability I talked about before. There you go. Number one question. Again, do I want VC investment? Do I want to go public? Probably want to lean toward a C Corp. Again, exceptions to everything, but if I say, Paul, quit the yak and just give me what I need to know, you probably, if you've got any institutional investors on the path, probably want to go C Corp. Am I going to make most of my money by selling my stock or from distributed profits? And those are alternatives. If it's the former, you're going to build some huge big entity and then you're going to sell it and you're going to sell the stock in that entity. That's taxed in a certain way. That's probably more of a C Corp thing. If it's the latter, meaning you are going to build the entity and it's going to be spitting out cash, you have a service business, for example, not a typical business that takes venture investment. Not great multiples on that because it's hard to make it grow. But you can have very nice businesses, very profitable businesses that are spinning off cash. Think about, landscaping businesses. It may not be what you're in, but you have 100 customers in a landscaping business or large businesses that need landscaping services. Well, guess what? They're paying you a lot of money, paying you a lot of cash. You pay the workers that are doing it for you. It's going to be making a profit. You want to take that money out for you. Maybe a pass-through entity is the right way. LLC or S Corp. Do I expect high losses early on? Now, number one, you have to finance those. So how are you doing that? That's one question. But if you're going to be financing it yourself, think about an S Corp or an LLC. Though there are, of course, exceptions to everything. An individual's ability to use the losses may be limited at certain points. Another thing, this is kind of a stop and pause moment and listen, because this is actually pretty important. This is important in that when you go to sell an entity, I talked about selling stock before. That's taxed in a certain way. A buyer who buys stock of a company and becomes the owner that way, which is typically what you do in C Corps, they don't have a very good ability to write down that investment. It's over a long period of time. If instead of buying stock, they say, I'm going to buy your assets, which is something they'd rather do anyway, because when you buy as a buyer assets out of a company, you can pick the assets, and a lot of times you can leave behind some of the liabilities. And if you buy assets and you assume some liabilities, there's a liability that no one's talked about. Well, guess what? Absent some exceptions, always exceptions, but for the most part, that unknown liability will stay with the seller because you didn't buy it as a buyer. So buyers like to buy assets, not only, again, because of that, but because there's a tax advantage in doing so. They get what's called a step up in basis, which means they paid $100 million for your business. They get to put $100 million on their books and depreciate those assets. And depending on the type of asset, there's different depreciation periods for those, but it can be a sizable tax advantage for someone to pay a lot of money to buy a company. If you're on the VC path, want to raise money through institutional investment, you're probably going to end up selling your stock. If you are on the path of, hey, I'm going to have earnings, you can end up selling your assets. And that's better, meaning you probably will get a higher price in an asset sale because of this tax advantage. Now, why wouldn't a C corporation just sell its assets? Double taxation. There's gain on the sale. It happens at the C Corp level, and then it's got a pot of money inside the C Corp, and then it distributes that money out to its shareholders, and those shareholders pay. The net of all that tax coming off the top means when you look at it, most companies that are C Corps do not want to sell assets. Now, there are exceptions, always except what if they have a bunch of losses, and then all those losses will, in fact, offset the purchase price. Maybe it works, but by and large, with C Corps, what we see are stock sales. And buyers would probably prefer, again, to do an asset sale. And if we're a pass-through entity, they might be able to pay a little bit more. It changes, strategic investors may not care so much. So they probably do at one level, but if they really need your product, they'll buy you regardless. Private equity funds, they have what I refer to as very sharp pencils. They know the mathematical models, and they're running all the scenarios, and they want to get the best tax advantage they can. They're looking to buy pass-through entities. Now, that may not be an alternative for you. Again, if you want to go out and get VC financing, you're going to be the next to name your company again, then that kind of forecloses that alternative for you. But brick and mortar type business, and we do a lot of M&A. I mentioned at the top, I'm the co-chair of our M&A group. Much of the M&A we see is actually by private equity, and when they're buying pass-through entities, whether it's whether an S corp or an LLC. Then sometimes they would prefer LLC for other reasons, and they have us switch those around just as a heads up. So you may be saying to yourself, doggone it, Paul, you've totally confused me now. What do I want to do? Go back to the rule at the top. Taking equity investment from institutional investors, you probably want to lean towards C corp. If you don't need to go down that path, pass-through entity may be your way to go. Where do you want to form? I mentioned Georgia Corporation at the top of the presentation. Why is that not fine? I live in Georgia. Well, the problem is most VCs are not in Georgia, right? There are probably some, and if they are in Georgia, they may be very, very happy with a Georgia corporation. California, not so much. VCs that are in California probably know California corporations. They may still prefer you to, I would say it's most likely they'd prefer you to be a Delaware corporation. Why? Well, we'll talk about that in a second. Key considerations: California or your home state. If you're done in Utah, you're going to have a lot lower franchise taxes than you do in California. If you just form there, will you be able to get a VC that invests in a Utah corporation? If you want to have a conversation with the VC, you probably want to be convincing them that you're the right company to invest in. So convincing that it's fine to invest in a Utah corporation is yet another conversation you have that takes away from the sales pitch. So by and large, if you're in Delaware, it eliminates a conversation. Everybody knows what a Delaware corporation is. Everybody knows how they work, at least everybody in the industry. And they're frankly usually better. Always a caveat. I said usually, but by and large, they're better. So considerations though, franchise taxes, if you are in Delaware, but you are, meaning you form the entity in Delaware, but you want to be located in California because you live here, you're going to be paying taxes in both jurisdictions, most likely. I, in fact, have a small business that I formed as a Utah LLC just to own some real estate, and I have to pay Utah's very low franchise taxes, and I have to pay California's relatively high franchise taxes because I live in California. I have to pay both sets. Corporate governance, another key consideration, and that's why institutional investors like Delaware. It is well known. The laws are well known, and I'll talk about that more in a second. People come to me all the time and say, hey, Paul, what about Nevada? I heard there's no tax in Nevada. Well, you're thinking about income tax. There's no income tax in Nevada because they're making a lot of money off high rollers, so to speak. But if you don't live in Nevada, it doesn't matter, right? You still probably gonna have to pay a franchise tax. I haven't checked to see what their fees are for franchise taxes, but that's not the issue. You're in California and you make income, you're paying California income tax, notwithstanding the fact that you have a Nevada corp. So does it help you to be in Nevada? Not really. They're a fine state to incorporate in for most purposes. Their law is considered similar to Delaware. However, you run into this again, their law is a little bit less well known. Delaware has had courts for 100 plus years interpreting its law. And then if you have an issue come up, and why did this law get created in the courts? Because it's arguments that people have had about how a corporation should be run. Many of those arguments have already been litigated in Delaware. They haven't been in Nevada. They haven't been in California even. So if you want certainty, Delaware is probably your choice. And that's why if you target, again, institutional investors, they're probably saying, I want you to be in Delaware. That entity I mentioned before, incorporated in Georgia, why did it come up? Because he was telling me, yeah, my investors are specifically telling me they want me to reincorporate into Delaware. Why? I went over it a little bit already, but they're the king of the state law regimes. They're actually very director-friendly, very management-friendly. California, for example, is very shareholder-friendly. They're trying to protect the little guy. Delaware is protecting the big guy, so to speak. Not exactly, but they believe in a system where if you put something into a contract, they're going to defend it. And if you say that a director has the right to be indemnified, which you do in Delaware, you have that in California too, but there's going to be more protection in Delaware. The standard is actually lower to qualify for indemnification of a director in Delaware. Why does that matter? A shareholder gets upset, they're going to sue somebody. Who do they sue first? They sue the directors. They go talk to a corporate lawyer like me. I'm not a litigator. I don't actually do this, but a corporate lawyer, and they say, I feel that I was really treated unfairly, and this is what happened, this is what happened, this is what happened. The first thing the lawyer will think about is the directors breached their duties to the shareholders. They have what are called fiduciary duties, and that's true of every state. Directors have fiduciary duties, but it's easier to contract around them in Delaware. Delaware law is much more settled on what the risks are, and it's easier to to eliminate those risks in a Delaware corporation. They have a specialized court called the Court of Chancery that deals with these issues, and therefore there are many questions already asked and answered. VC is also no Delaware law, so you're in good hands in Delaware. Most companies, if they're not in Delaware to start, they will reincorporate their pre-IPO anyway. If you go talk to an investment banker, they'll say, yeah, no, you got to be Delaware. There are exceptions to that. Last I heard, Adobe was a California corporation. I haven't checked that in a few years, but very few exceptions to this. And as a heads up, if you're thinking, well, I'll just start where I am and pay, I'm in Utah, I'll pay those low franchise taxes that Paul was talking about and switch later. It's harder to switch later. The more stuff you got going on in the entity, by the time you pay a lawyer like me to deal with all the issues you have on reincorporation, it may dwarf the cost of actually just paying those taxes from the start. So my general rule of thumb is just start in Delaware. Again, if you're taking institutional investment, going back to if you're not, you want to form an LLC, hey, California LLCs are fine. Delaware is probably a little bit better still. You may be paying more, but Delaware, again, they respect the contract. They're not going to show up and try and protect the little guy like California courts will. And so you have more certainty about what should happen if you're litigating an LLC. So why would you choose California? Well, the franchise tax issue, you probably have to pay twice. You have to pay an agent to take service of process. In other words, if someone's suing you, every state wants to know that they can find you and serve you the lawsuit, and you have to pay someone to do that for you in Delaware. So you'd save that cost if you stayed in California. Also, some of the advantages of a Delaware corporation are not applicable to California-based companies. California has what's called a long arm statute, where they say some provisions of our California law are so important that we're going to impose them on every other state's corporate law too. That is of questionable constitutional validity. However, in the last round of litigation I heard about, which has been a couple of years, Delaware said, doggone it, California's rules don't apply to our corporations. So California buzz off. California's response was, no, they do. And so if you're a California corporation or a California owner of a Delaware corporation, where do you fall? We have to tell clients, you probably have to respect of corporate laws, at least for the matters that are covered by this Section 2115, that is, again, claiming that California law takes superiority over your home state for certain matters. Again, of questionable constitutional validity, but do you really want to be the one that's going to pay lawyers to litigate that? The cumulative voting is treated differently in each state. Approvals for a sale treated differently in each state. Anti-takeover defense is a little bit different. Director indemnity standards I mentioned before, a little bit different. And just one last note is that Delaware standards have been changing lately. There have been some high-profile cases, some of which involving Tesla and Elon Musk, about the risks that people have when they are the controlling shareholders of these entities and what procedures they have to go through to do deals with related corporations. And Delaware has been imposing new standards on that to the point where some corporations that are in Delaware have been making noises about getting out because they don't like those new court cases. So just as a heads up, still, I think the answer is formed there. And I hope that this was useful to you. We do this in the hopes that you think, hey, doggone it, I really do need to talk to a lawyer. And if you want to talk to a lawyer, reach out, but we'd be happy to help. And we can answer some of the more specific questions. I hope to see you in real life someday. Thanks a lot.